And now, without any further delay, I would like to turn today's event, Affordable Care Act Employer Seminar, What Does It Mean for Your Business?, over to your presenter, Ross Dwinell. Ross, you now have the floor.
Well, thank you, Nicole, and good morning, everyone. On this Halloween morning, probably pretty fitting to be talking about the ACA, or the Affordable Care Act, on Halloween as a trick-or-treat type of approach. That will be the only attempt at a joke I'll provide you this morning. I want to also thank everybody for, well, those of you that did submit questions. We have them in advance of our presentation. We will answer many of those questions within the presentation itself, but most likely not all of them. And then Tom will gather up any questions you may be submitting through the process, through the course of this discussion, and we'll address them directly at the end. And please feel free, and I'll say this again at the end, that if there's any questions you may have, please contact either Tom Newton or myself, either via email or call our Portland office, and we'll be more than happy to respond. I do want to do two introductions for you this morning, following up on Nicole's comments. The first person I'll introduce is Tom Newton, who's Director of Sales of the Unified Grocers Insurance Operations in the Northwest in Oregon. And then the attorney that will be doing most of the talking this morning is Katherine Somervell. Katherine is a partner at the law firm of Bullivant, Bailey. She's a specialist in ERISA, and I've gotten to know her very well over the last few years, and certainly over the last 6 months, regarding the implementation of the ACA Act. So thank you again for attending, and now I'll ask Katherine to step in.
Hello, everyone. Thanks for joining us this morning. Ross already made the Halloween joke, so I am going to not make mine, although I was going to say that it's appropriate because the ACA is pretty scary for some people. And that's the end of my jokes. What I wanted to do is just give you an overview of what's going on with the Affordable Care Act, because things have been changing. There's a lot of moving parts. The first thing, though, I want to make you aware of is that because all of you have coverage through the trust, you're covered. You've got some control. The good news is that you're already compliant with the law. It provides you with minimum essential coverage required by the law, and Western Grocers Trust and Unified Grocers are going to make sure it stays that way. The not so good news is that the law is incredibly complex. It keeps changing all the time. As much as just, last week they were making some more changes to it. We're still waiting on key regulations and guidance. So a lot of what I'm going to be talking about today is still sort of unsettled, but I will tell you what's going on as best as possible. We know that you're going to have some questions. We know there will be lots of questions. Some of the basic questions that we know about are going to be, when does the ACA go into effect? There's been some things that have been postponed to 2015. The primary answer, though, is that the ACA has already gone into effect and went into effect a couple of years ago. There have been many components that have been staged and drawn out over the next few years. So there are things you need to be compliant with now, even though the employer mandate, which is also known as the pay or play penalty, has been postponed to 2015. And we'll go into those in more detail as to what exactly you need to be aware of now. This is the big question. I'm sure you're wondering, what am I required to do? Because you know things have been postponed. You know that there are some requirements out there that you may need to comply with, or that the plan needs to comply with, and I'm going to make it clear which ones you need to be worried about and which ones the plan has taken care of. So although there are lots of moving parts, things are constantly changing, regulations are still coming out, guidance is still coming out, and things are being postponed, I'm going to do my best today to demystify the Affordable Care Act for you so that it's still complex, but at least you'll understand what's going on. And one of the first demystifications I'll do, just in case anyone out there is confused, when I refer to the Affordable Care Act, I'm referring to what is commonly known as Obamacare. They are the same thing. I know there's confusion out there. CBS did a poll about these the two terms, and a lot of people are confused and they think they're different things. They are the same thing, but I refer to it as the Affordable Care Act because that's its official name, and I'm a lawyer and I'm supposed to use the official name. So, again, part of the reason for this, actually the entire reason for this webinar today, is that Western Grocers Trust and Unified Grocers are on your side. They want to make things as easy as possible for you to comply with the law. They know that you want to provide health insurance to your employees. You do already. We know you're concerned about how penalties apply. You know, you've heard that a lot of other employers out there are dropping insurance for various reasons. And Western Grocers and Unified Grocers want to make sure that they give you the best possible options available. They know you run a business. You want this to be as cost-effective as possible. Well, that's what they're doing for you. Because the plan is self-funded, the trust is self-funded, there are a lot of fees and other requirements that insurance companies have to comply with that will increase their rates. Western Grocers Trust is able to keep it more affordable because they don't have to comply with a lot of those other fees and requirements that need to be taken care of. And the goal for Western Grocers and Unified is that they want to make everything happen while you're maintaining compliant with government mandates. So they'll make sure that you're compliant. And as I said, my job today is to help you understand what the plan is taking care of for you, but then what you need to worry about on your end. And there actually aren't that many things you need to worry about on your end. There's been lots of confusion over what the employer has to do and what the health plan has to do. And this is just a little overview right here. The employer has to be concerned about the pay or play penalty. That's the employer mandate. Note that it only applies to large employers, and we will discuss that later. And it's also been delayed to 2015. Okay? The large employer auto-enrollment has also been delayed to 2015. Now, there is also a maximum 90-day waiting period for eligible employees. That applies now, okay? So you need to make sure, and that applies to everyone. So usually employees become eligible, you know, on the first day of, it's common for them to become eligible first day of hire if they're full-time employees, and then there's a 90-day waiting period. So there has to be no more than 90 days from the date they become eligible. I know there are some union guidelines where people have to work a certain period of time before they become eligible. We'll discuss those in a little bit. Large employers, I guess larger employers, this is one of the confusions that has to do with the Affordable Care Act, is that large employer is defined a couple different ways. For purposes of the pay or play penalty and auto-enrollment, there's one definition. For the requirement to report the cost of coverage on the W-2 forms, there's a different one. So only employers with 250 or more employees have to report the cost of coverage on W-2 forms. If you're under 250 employees, you don't have to worry about that right now. There is no deadline right now for when the IRS is going to implement it for employers who have fewer than 250 employees, but they're going to give 6 months notice. They say they're going to give 6 months notice. And then employers are also responsible for this patient-centered research fee, patient research outcome fee. And that will be assessed by the trust, and the trust will pay it for you. But that's one of the employer responsibilities, but the trust is taking care of that for you. Now, the plan has different requirements, okay? The plan has to worry about a limitation on out-of-pocket maximums. It can't exclude pre-existing conditions. Any dependents who are covered must be covered up to age 26. There are no lifetime or annual maximums, and the plan has a different reinsurance fee that they have to take care of. When you hear about, you know, covering dependents to age 26, when you hear about out-of-pocket maximums or pre-existing conditions, the trust is taking care of that in the plans that they offer to you, okay? So you don't need to worry about those for your employees right now. Anything that the plan offers you, anything that the trust offers you will be compliant with federal guidelines. So what's happening in 2014? In 2014, the individual mandate is going into effect, and that is that individuals who are over a certain income level have to purchase insurance or pay a penalty. There have been problems, as everyone knows, with the healthcare.gov website. The White House has announced that the deadline for people to get on the exchange has been delayed by 6 weeks. So now the penalty won't apply as long as individuals are covered by March 31st. One of the reasons I'm mentioning this is because one of the questions that we had from one of our participants in advance was, what do I tell my employees? How do I answer my employees' questions? And we anticipate that your employees may have questions about the individual mandate. Now, that shouldn't be much of a problem for you because you're providing insurance to your employees, but to the extent they have questions, we want you to be able to be informed. Also in 2014, the state exchanges go into effect. They should be up and running now so that people can start enrolling for insurance. But as everyone knows, there's problems with websites and there's problems with implementation. There are two different types of product offered on the exchanges, and one of them is for individual insurance for individuals. The other one is for small employers, and that's called the SHOP exchange, S-H-O-P. States had the option of creating their own exchanges, or where they don't create their own exchanges, the federal government will step in. So Alaska's exchange, for example, is going to be operated by the federal government because Alaska did not offer an exchange or create an exchange this year. Oregon and Washington are planning to offer employer exchanges. Oregon's is up and ostensibly running. They're having problems with their computer system right now, but it's ostensibly up and running. Washington, on the other hand, did not get enough insurance companies interested in the exchange, and they will not offer the employer exchange for small employees until 2015, except for Clark County, where Kaiser is going to be involved. Small employers, by the way, are under 50 employees. So you won't need to go to the exchange because Western Grocers has you covered, but that's just what the exchange looks like. There's the individual exchange and there's the SHOP exchange, which is limited, as I said, at this moment. The employer mandate is delayed till 2015. Now, as I said before, the employer mandate is the pay-or-play penalty that applies to large employers, okay? If you have under 50 full-time employees or full-time equivalent employees, which counts your part-time employees, you don't have to worry about the pay-or-play penalty, okay? If you're on the cusp and you may be, going over that 50 or your part-time employees are numerous enough to get you over that 50 full-time equivalent, then you're going to need to worry about the employer mandate in 2015. As I said previously, everybody has to comply with this no waiting period longer than 90 days from the date of eligibility. That's effective now, and it's effective for everybody. It doesn't include training or apprenticeship time required by a collective bargaining agreement before the employee is eligible to participate. So there are certain circumstances where an employee is hired, and under the collective bargaining agreement, he'll have 90 days of training before he becomes eligible to participate in the health plan, at which point, when they become eligible, you can have 90 days before they're actually enrolled in the plan. So there can be up to 180 days where the employee is not covered by insurance. This is allowed under the ACA. The extension of the 90 days is allowed for that period of apprenticeship time under a collective bargaining agreement. The glitch is that for that first 90 days where they're not covered under any plan and they're not eligible to be covered yet, the employer penalty can apply for large employers because you have full-time employees who are not being provided insurance. That is sort of a gap that has not been taken care of yet. Basically, the Affordable Care Act was pieced together very quickly, trying to address a lot of various interests, and some things like this just fell through the cracks. And there's no guidance yet on how that's going to work out. That's probably another reason that it's good that the employer mandate was delayed until 2015, because the penalty is not going to apply until 2015, and by then they should figure out how it works. But for right now, there can be up to 180 days before somebody is eligible if they have that required 90 days under a collective bargaining agreement before they become eligible. I want to talk a little bit more about what the health plan requirements are. This is something, as I said, that the trust is taking care of. You don't need to worry about it, but these are just some things that your employees may have questions about. The out-of-pocket maximum is now limited to $6,350 for an individual, $12,700 for a family per year for in-network essential health benefits. The out-of-pocket maximum is what the employee pays out of his own pocket for the health coverage and what they pay for medical bills. These are capped for in-network. If the employee decides to go out of network, the out-of-pocket maximum can go higher than that. There are no annual or lifetime maximums anymore. There used to be caps on what the plan would pay. You know, they'd say we will not pay more than $1 million in a year. So if you had a catastrophic injury that cost more than $1 million, you could be on the hook. Those annual or lifetime maximums are eliminated. Pre-existing conditions can no longer be excluded under the plans. This applies for both individual and group coverage. For group plans, there used to be a 6-month limitation. Now that's gone. They can't do that anymore, and the plans that the trust is offering have no exclusions for pre-existing conditions. Dependent coverage, when it's offered, must be paid up to age 26. I presume this is to cover all those parents who have kids who are in grad school or otherwise living in the basement. But it goes up to 26 now. We'll talk about whether you have to provide dependent coverage in a bit, but to the extent that coverage is provided under the plan, it'll cover them up to age 26. The health plan also has a transitional reinsurance fee that goes into effect. That's $63 per enrolled individual. The plan is taking care of that. The individual mandate, again, I'm going to discuss it just briefly in detail just so you can answer questions that might be posed to you by your employees. First of all, as I said, it's been absent certain exemptions, all individuals must purchase qualified health insurance or pay a penalty. As I said, that's been delayed by 6 weeks, so individuals don't have to do that or get covered until March 31st. They can obtain health insurance through 2 sources, through the state exchanges, or the employer provides health insurance, which is what you're doing. A qualified health plan must offer certain minimum essential health benefits. One of the things you've been hearing about in the news is that a lot of insurance companies are quote-unquote dropping individuals from coverage. They're not so much dropping coverage as it is that the plans that they have been providing for individuals do not meet the ACA's requirements for this minimum level of essential health benefits. And so those can no longer be offered because they don't meet government guidelines. So those are going to have to be revamped. They're going to have to move people to plans that actually do meet the federal requirements. It's estimated that 150,000 people in Oregon alone are going to be forced to change coverage, their individual coverage, because it's not compliant. And so that's an issue that will need to be addressed. But I know you're providing coverage to your employees about that. But I know you're hearing in the news that people's coverage is being dropped, and They're being dropped from coverage only because the plan is not any good and it needed to be changed. This is the big one, the employer mandate, also known as the pay or play penalty. In a nutshell, beginning in 2015, large employers must offer affordable health coverage to full-time employees and their dependents or pay a penalty. Virtually every word in that sentence I just read is a defined term under the ACA and is not what it appears to be at first glance. Okay, large employer is defined, affordable health coverage is defined, full-time employees are defined, dependents are defined, and the penalty is defined. So as an overview, large employers have to offer affordable health coverage in 2015 to full-time employees and their dependents or pay a penalty, and we are now going to drill down and explain, if this applies to you and how it applies to you. First of all, the mandate only applies to large employers. Okay, as I said, that's 50 or more full-time employees or full-time equivalents. Full-time equivalents takes into account part-time employees. Okay, if you have under 50 full-time equivalents, you're not required to provide insurance. You're not subject to a penalty, nor will you be subject to a penalty even in 2015. Okay, the whole mandate does not apply to you. One of the things I will point out is that part of the pay or play penalty of the employer mandate is the full-time employee requirement, which is defined as 30 hours. If you're not a large employer, don't worry about 30 hours equals full-time requirement, because that's not going to apply to you, and it will not apply to you in 2015. Okay? If you have 50 or more full-time equivalents, then beginning in 2015, you're required to provide minimum coverage for full-time employees, and beginning in 2015, full-time employees will be defined as 30 or more hours. That's under the statute. And then you will have to pay a penalty if the coverage provided is insufficient or if it's not provided at all. And each one of these issues will be drilled down into a little bit more. First, you need to figure out how to count your full-time equivalents. As I said, if you have fewer than 50 full-time employees, you're golden right now. You don't even need to do a calculation because you're already out. If you have a mix of full-time and part-time employees, you have to do a calculation. For purposes of calculating FTEs, you do use the 30 hours a week requirement. And that's just for purposes of this calculation. Okay? Again, the 30-hour requirement doesn't go into effect until 2015. The pay or play doesn't go into effect until 2015. But if you're going to do your analysis in advance to figure out if you're going to be subject to the pay or play penalty, you count your full-time employees as anyone who works 30 or more hours a week. Okay? Part-time employees, what you do is you take their hours of service per month and divide it by 120 hours, which is the hours that a full-time employee puts in. The calculation is based on the previous year's average, and businesses under common ownership are going to aggregate their employees, okay, for purposes of this. Here's an example. You have 40 full-time employees, and you have 30 part-time employees. They work between 10 and 29 hours a week. What you do, and they have monthly hours of 720. If you divide that by 120, you have 6 full-time equivalents. You add that to your 40 full-time employees, and you are 46 full-time equivalents. You're not subject to the employer mandate, which goes into effect in 2015, and you don't have to worry about it. A lot of you I know have seasonal employees. If you have seasonal employees, you still do the calculation, but there's sort of a safe harbor exemption. Under this example, it's the same as before, except the employer hires 30 extra part-time seasonal employees for the summer months. Okay, so you still have 40 full-time employees, but now you have 60 part-time employees for the months of June, July, and August. Now their total monthly hours are 1,440. You divide that by 120, and you have 12 full-time equivalents. So for those 3 months at least, you have 40 full-time, 12 FTE, and you have 52 FTEs, okay, which would appear to get you over the threshold and make you subject as a large employer. There is a safe harbor, however, for these seasonal employees, and if they worked fewer than 120 days, then they can be excluded from the calculation. So if those seasonal employees are, and their time is what's throwing you over the top and turning you into what would be a full-time employer, a large employer, you can exclude those people if they worked fewer than 120 days. So under this example, the employer still would not be a large employer under the ACA subject to the employer mandate because those extra 30 part-time employees will not be counted because they worked fewer than 120 days. I see that we've got a couple questions. Tom, are those ones we should answer now or later? I haven't had a chance to read them. Oh, okay. We will hold those. People are asking questions, which is great. We're going to hold those till the end right now, but do be advised that we have your question. Let's move on right now. If you have under 50 full-time equivalents, you have no requirement to provide insurance. There is no penalty. The employer mandate provisions don't apply. There are no requirements for you whatsoever with respect to providing insurance. There's no requirement for you to provide dependent coverage, and there is no requirement for you to define full-time as 30 hours per week. Okay? There are, however, if you have fewer than 25 employees, there are tax credits which might be available to you. Those are, as of 2014, you can only get those tax credits if you go onto the exchange, provided that, a certain portion of the contribution is paid by the employer. What will happen is if you do an analysis, it's entirely possible you may end up paying, even with the tax credit, you may end up paying more simply because the exchange prices can be higher because they're funded by insurance, and as I mentioned previously, the trust doesn't have to pay a lot of those extra fees and can keep costs lower. If you're a large employer, you have 50 or more full-time equivalents. This begins in 2015, the pay-or-play mandate, okay? You have to offer affordable minimum essential coverage to all full-time employees and their dependents. For purposes of the pay-or-play penalty and the mandate in 2015, full-time is 30 or more hours a week. Right now, as of 2014, there's no requirement to define full-time employees as 30 or more. Okay? That doesn't kick in until 2015, and when it does, it only applies to large employers, not small employers. The requirement to provide coverage to dependents does not include the employee's spouse. The purpose of this is to make sure that children are covered and they're not left out in the cold without insurance. Spouses often have coverage through their own employers. Spouses can also go onto the exchange and get individual coverage, and their doing so will not jeopardize your provision of benefits under the ACA. You won't have to pay a penalty because someone's spouse goes onto the exchange. Large employers in 2015 who don't offer this affordable minimum essential coverage to full-time employees and their dependents will have to pay a penalty. The penalty also applies if they don't provide coverage, but it's not affordable. Again, affordable is another defined term that we will get into in a bit. Now, minimum essential coverage is what the plan has to provide, and it's a plan thing. It's based on an actuarial percentage of cost sharing. It requires 60% of all health care expenses to be paid by the plan, 40% to be paid by the employee. That's a minimum. Common coverage often has an 80 and a 20%, where 80% is paid by the plan and 20% is paid by the employee in forms of co-pays and co-insurance. The minimum coverage must be the 60-40 plan in order to be compliant with the law. And meeting this requirement can be accomplished by a mix of deductibles, co-pays, co-insurance. The trust offers several plans. All of them meet this requirement. So you don't have to worry about that. You will know that getting your coverage through the trust will meet this minimum essential coverage requirement. That's one portion of the pay-or-play mandate that you will not have to worry about. Now, the coverage also has to be affordable, okay? Now, that's defined under the law as that it's affordable if the employee's portion of the employee-only premium is less than 9.5% of their household income, okay? Now, bear in mind that in 2015, large employers must provide coverage to employees and their dependents, okay? For purposes of calculating affordability, the dependent coverage is not included in this calculation. So what's going to happen is, for example, the employee pays $100 for just their self only. They may have to pay $300 a month in order to cover their dependents. But the affordability only looks at the employee-only portion of the premium. And it must be less than 9.5% of their household income. Well, I'm pretty sure that you don't know your employee's household income. And it's very invasive to ask them, what their household income is, or to have them turn over a copy of their, tax forms. So what the law has done is it's provided some safe harbors for employers to figure out how to determine affordability. And what this does is this looks solely at the information that is readily available to the employer, okay? That there are three different methods. You can look at the wages that were reported on the W-2. You can take their hourly rate and multiply it by 130, or you can compare it with the federal poverty line. And so what the employee would pay for employee-only coverage must be less than 9.5% of any of these three benchmarks. Here's an example, because I know it does get confusing. You have an employee who makes $9.10 an hour, and their W-2 reported earnings were $16,562. The employee-only coverage is $200 a month, for which the employer pays half. Okay? The employee therefore pays $100 a month, or $1,200 per year. As I mentioned previously, the additional amount of premium paid for dependent coverage is not included in the calculation. So it's possible that the employee may be paying personally far more than just $100 a month to get coverage for the employee and dependents. But for purposes of affordability, it may seem counterintuitive to cut out dependents when you're determining affordability. You don't count the dependent coverage, okay? So this is our baseline example. The employee is paying $100 a month, $1,200 per year for their own personal coverage. So you do a calculation. And based on this example, the coverage is affordable under all three of those calculations that you can do. For the W-2 calculation, if they make $16,562, you multiply that by 9.5, that's $1,573.39. They're paying $1,200 a year. It's less than that. They're good. For the hourly rate calculation, the 910 by 130 hours, 9.5% would be $1,235. They're paying $1,200 a year. It's still affordable. If you use the federal poverty level calculation, for 2014, the federal poverty level for a single individual is $15,282. Multiply that by 9.5%, it would be $1,451. Again, they're paying $1,200 per year, and they're below the 9.5%. So that's how you determine it based on the information that's available to you to determine if the coverage is affordable. It's entirely possible their spouse, may be making a lot more money, but this will guarantee that that what you're providing is affordable to them. Now, the penalty. When does the penalty apply? It applies if the employer doesn't offer the minimum essential coverage at all, and if an employee receives a premium tax credit or cost-sharing subsidy to purchase through the exchange, and the coverage provided is not affordable or insufficient. Okay? There's a lot going on here. Okay? The first prong is the employer doesn't offer the coverage. The employer pays a penalty. Okay? The second prong there is that the employer provides coverage, okay, but it's either not affordable, which means the employee-only premium is greater than 9.5% of their income, or the coverage provided is insufficient. That means it covers less than 60% of the planned costs. The penalty is triggered by if an employee receives a subsidy, okay? Medicaid-eligible employees are not entitled to a subsidy. So if you've got someone who's entitled to Medicaid, if they go and they're not entitled to a subsidy, so they're not going to get on the exchange and obtain a subsidy because they're getting Medicaid. So any Medicaid-eligible employees that you have who are not able to afford your insurance, it's okay because they're covered by Medicaid. They're not getting a subsidy. A penalty would not apply. The premium subsidy is available to employees earning between 133% and 400% of the federal poverty level. Okay? For 2014, that's between $15,000 and $45,000 for an individual, or between $23,000 and $94,000 for a family of four. This covers a lot more people. Okay? So if someone if the coverage you're providing is not, if you don't provide coverage at all, or it's not affordable, which is the employee-only premium is, greater than 9.5% of their income, and they go to the exchange, and they're eligible for a subsidy, then the penalty will apply. And I realize that this is getting very confusing at this point because there are lots of subdivisions of each thing I'm telling you. And I apologize for that, but I did not draft the law. The penalty calculation is different depending on if you don't provide coverage at all or if the coverage is insufficient. Okay? If the coverage is not provided at all, it's $2,000 times the total number of full-time employees, less 30. You get 30 free employees before the penalty kicks in. Okay? So, and that's full-time employees, not FTEs. That's another way the law is confusing. FTEs are full-time equivalents. You use full-time equivalents to determine if you're a large employer. But once you determine you're a large employer, then you're only looking at full-time employees. Okay? So if you don't provide coverage at all, it's $2,000 times the total number of full-time employees that you otherwise would have been required to provide insurance for themselves and their dependents, less 30 free employees. Okay? If coverage is insufficient or it's unaffordable, then the penalty is the lesser of $3,000 for each full-time employee who receives a tax credit or cost-sharing subsidy through the exchange. So someone who can't afford your coverage, it's more than 9.5% of their income, or the employee-only share is greater than 9.5% of their income. They go to the exchange, they get a subsidy. You get a penalty because they meet those criteria. Or the penalty assessed if no coverage is provided, which is the $2,000 per total number of full-time employees. So they'll make you pay the lesser of one of those two things for that second prong if the coverage provided is unaffordable. I tried to turn this into sort of a flow chart, and I'll tell you right now, it is virtually impossible to turn this into a flow chart because there are just too many variables. There's a safe harbor here, okay? The employer safe harbor is that they'll not be liable for penalties even if the employee receives a tax credit, as long as the employer offers minimum essential coverage to full-time employees and their dependents, and the employee-only premium for the lowest cost coverage that provides minimum value is less than 9.5% of the employee's W-2 wages. So that goes back to how you calculate it, okay? If you calculate the 9.5% based on their W-2 wages, then as long as you provide minimum essential coverage and it meets that affordability thing, then you're not going to be liable for penalties even if they go and get a tax credit on the exchange. Okay? Again, all of this applies only to large employers and it only kicks in 2015, okay? So if you're confused, you have a year for me to keep explaining it to you or for Ross to answer your questions. So you're over 50 FTEs, and you're wondering if you should pay or play. Well, dropping insurance in favor of paying the penalty does not necessarily result in cost savings. I know there's a lot of press out there about larger employees, dropping insurance and all this sort of stuff. And, I assume they've done their actuarial analysis, but it doesn't necessarily result in cost savings, because the first thing that happens is there's the fine, which is $2,000 per full-time employee after the first 30. They lose the 35% tax deduction that they get for employee health expenses, and there's a loss of the 7.65% in FICA tax deduction for employee health expenses. So there's a definite tax penalty that will apply, or that they'll lose some very nice tax credits if they choose not to provide coverage and instead go for the penalty. Other reasons why you might not want to just drop coverage, okay? Well, you can drop coverage. It may reduce your labor costs, reduces your regulatory reporting requirements. There's less for you to do. It can save time spent in bookkeeping in the enrollment process. It eliminates the employer involvement in the employee's claims concerns, and it gives the employee choice. The employee can go on to the exchange and purchase insurance. So those are some things you can think about. They might be pros for you. For the cons, however, you may lose good employees because they may go elsewhere to find someplace that has coverage. It may encourage employees to seek union support. It might increase sick days and workers' comp claims because they don't have health coverage, or the coverage that they've been able to get from the exchange for individual is not good, and they're not encouraged to go out and use it. Any compensation that you might pay in lieu of benefits would need to be grossed up. For example, for $100 that you would pay right now for an employee health benefit, that would have to go up. That would need to be increased. If you decide to change it to money and just give them money to go buy insurance, that would have to be increased to anywhere between $140 and $190, depending on the taxes that they have to report and that get deducted from their pay. There's uncertainty as the viability of the exchange in light of federal funding issues, and the employer's own plan choice is something that you can have now. You have control over the plan. So obviously the trust has a vested interest in wanting you to stay with them, but of course we know that you're thinking about all the options, and we want to point out what the options are and what you need to be considering as you see other employers deciding to perhaps just drop coverage. There are other things out there that are not necessarily affected by the ACA, or that aren't huge things you need to be worried about, but they are out there, and we wanted you to be aware of them. This is, acronym land. We have HSAs, we have FSAs, we have POPs. Okay, those are health savings accounts, flexible spending accounts, and premium-only cafeteria plans. I don't know how many of you have these options, or if you're considering these options, but I did want to let you know that health savings accounts are employee accounts that are tied to high-deductible health plans. And as far as the ACA is concerned, the 2014 annual contribution limits are capped at $3,300 for employee-only coverage and $6,550 for family coverage. So that's how the ACA is affecting health savings accounts. Flexible spending accounts are different. Those are salary reduction mechanism by which employees can use pre-tax dollars to purchase or be reimbursed for medical expenses. Okay. The changes that have gone into effect with the ACA is that a prescription is required if you want to be reimbursed for over-the-counter drugs. It used to be that over-the-counter drugs you could pay with your flexible spending account. You can't do that now unless a prescription has been provided for those over-the-counter drugs. And employee contributions are capped at $2,500 Premium-only plans, premium-only cafeteria plans, are where the employer contributes the cost of the premium to an employee cafeteria plan. And the employee then uses pre-tax dollars to pay for insurance premiums. The catch here is that the ACA has amended premium-only cafeteria plans to make it very clear that those dollars cannot be used for individual insurance purchased on the exchange. The tax benefit goes away if that money is being used by individual insurance. So a premium-only cafeteria plan is not going to really help with respect to deciding whether to pay or play, because it's not going to work if you just give the employee money to purchase their own insurance on the exchange. I wanted to go over another quick summary now that I've talked about most things in detail. Okay, let's just go over the summary again and make sure that we refresh our recollection as to what's going on. And again, we'll do employer requirements versus plan requirements. For employers, there's a pay or play penalty. It applies only to large employers, and it's been delayed until 2015. And again, that pay or play penalty includes with it the 30-hour requirement. It includes the requirement to provide dependent coverage. That only applies in the context of the large employer penalty in 2015. Okay? The maximum 90-day waiting period for enrolling new employees, that applies to everybody now. If you have a collective bargaining agreement that provides an extra 90 days, just be aware that if you're a large employer in 2015, there may be a penalty assessed for those 90 days before they become eligible for coverage. Hopefully there will be guidance before 2015. Right now there isn't, but as I said, again, you don't have to worry about it right now, penalty-wise. Any employee working 30 hours a week must be eligible. That's part of the large employer penalty that goes into effect in 2015. Employers with 250 or more employees must report health premiums on the W-2s. That's, again, the large employer, not the large employer that's 50 FTEs, but with 250 more employees. And the fees are $1 per employee for 2013, $2 in 2014, and the trust will be taking care of that for you. Plan requirements, as I said, the trust is taking care of this for you. You can be aware of it, but it's not something you need to worry about. The annual out-of-pocket maximum cost to employee is $36.50. For the employee, it's $12,700 for the entire family limit. There's no pre-existing condition exclusion in the plan. If a plan covers dependent children, it must cover them up to age 26. Again, at this time, there's no requirement to provide dependent coverage. The requirement to provide dependent coverage only applies to large employers beginning in 2015 as part of the employer mandate. There are no lifetime or annual maximums for what the plan will pay. Benefit plans have to be considered affordable by formula, and again, that's something that the trust is taking care of, and anything that you're being provided or offered will be, you need to determine the affordableness, that's the 9.5%. The minimum value, which is the next entry, is what the plan's taking care of. They're making sure that everything meets the definition of minimum value. Benefit plans must be considered affordable. That's the 9.5% of the employee's W-2 wages or those other calculations that were provided. And then the fees within the plans will be $63 for each enrolled employee. That's paid by the plan. All right. That is our summary of everything right now. I know there are questions, and that's why we allowed plenty of time in this webinar for people to ask questions. We've gotten some text questions. We had some questions that were posed to us before when people were registering, and there will also be an opportunity, I believe, for people to ask live questions. So at this point, I'm going to turn it back to Nicole, our moderator, to provide some guidance as to how you can ask questions.
Thank you,
Nicole?
Katherine. Yes, thank you. Ladies and gentlemen, at this time the lines are open for questions. If you are already dialed in via phone, you can press *8 on your telephone keypad if you'd like to ask a question live. Questions will be answered in the order they are received. Again, that's *8 to ask a question live. If you have not dialed in via phone and you would like to ask a question live, I'll be providing the phone number to do so in the Q&A momentarily. Or if you've not had a chance to submit a text question or comment, you can do so by clicking the Q&A tab at the top of your screen, typing your question or comment into the window that appears, and then clicking Ask. So I'll hand the floor back over to presenters now to answer questions that have come in.
Good, Katherine. Okay. Oh, I'm sorry. Okay, Katherine. Megan asked, must we establish an initial measurement period for temporary employees?
No, but they shouldn't be longer than 90 days. I mean, if you have a temporary employee who's going to be longer than that, then they should be, then they're an employee, and they'll be covered later. So you just need to worry about that. Now, again, this is for larger employers, you know, who satisfy this. Anyone who's not a large employer does not have to worry about the pay or play penalty and doesn't have to worry about how to calculate full-time employees and when to provide coverage. So the quick answer is if you're going to have a temporary employee who's going to be working for you for a year, then yes, if you're a large employer in 2015, you're going to have to provide coverage for them because they are your employee.
Ross, I'll ask you, one of the attendees asked about rate increases and how that may affect their business and employees. What can they expect?
Well, as most all of the owners have experienced and all of you on the phone, rates have seemed to increase for the most part every year, and most of that is driven by the cost of health care and the delivery of health care. This particular law will add some expense, but not that much. As Katherine pointed out a couple of different times, the trust is self-insured. All of you participate in the plan in a self-insured arena, and we don't have some of the expenses and costs, regulatory costs in particular, that the other insurance companies or insurance carriers have. I think the increase this year was about 3%. It's very difficult to say. I will add two things. This year, Katherine spoke about no annual maximums. Well, that, you know, we may get a $5 million claim, and that's going to cost something. We hope that's not the case. And then no pre-existing conditions. That also will have some impact the first year, but after that, not that much. And I'm speaking only within 1 to 2 points. That's what we've been able to negotiate with with the insurers that we do business with.
Katherine, Gail wants to know if you have two separate legal entities, for example, if you own 2 stores and they're established as separate legal entities, do you have to add them together for the calculation of full-time equivalent?
That's a good question, and it depends on, this is based on this does is it takes it straight from the IRS guidelines of common control, okay? And so if for purposes of reporting taxes, you report, you know, one big entity and everybody's underneath it, then yes, you aggregate everyone. If you have separate entities for purposes of tax reporting, then you don't have to, okay? But if they're just, if you have one big company and you have a lot of smaller stores or something underneath that, then you need to aggregate them just as you do for IRS purposes.
Thank you. And Mike's asking, does dependent coverage have to be paid in part by the employer, or do they just need to offer coverage if they are willing to pay the additional premium? And I also think some clarification about dependent and spouse might be helpful.
Okay, that's another good question. All right, I have to begin this with a caveat. Ross and I, as Ross mentioned, he and I have had lots and lots of discussions over the past few months as to how this is, the ACA is fleshing out. And with the delay of the pay or play penalty to 2015, we enter sort of an MC Escher world, because Ross will ask me, you know, is this required? And I'll say no. because it's not required now, but in 2015 it may be. And so we tend to think in different time periods. So what I want to do when we're talking about this dependent coverage is I want to clarify, okay, that dependent coverage being provided is only required to be offered to large employers in 2015, okay, by large employers in 2015. Right now, for 2014, nobody needs to offer dependent coverage, okay? Now, to the extent you're looking forward in time to when 2015 is going to hit, then that's fine, and dependent coverage just has to be offered, okay? Does it have to be paid in part by the employee? It can be paid entirely by the employee because it just needs to be, the purpose of the Affordable Care Act is to give everybody coverage, okay? Now, and to make sure that children are covered. Adults kind of need to fend for themselves, okay? And so if a spouse is not covered, the spouse can go on the exchange. So you have an employee, okay, who's a full-time employee, has 2 kids and a spouse, okay? You need to offer dependent coverage, okay? Now that dependent coverage would just, you don't need to offer spousal coverage, which would also be family coverage if you're going to, get everybody in there. All you need to offer, as required by the law, is the employee-only coverage plus dependent coverage if they have dependents. To calculate whether it's affordable, you only look at the employee-only coverage, okay? And the portion of what they pay for the employee-only coverage. So that's where you would kick in part of the premium in order to make it affordable for them. There's no requirement that the employer kick in or pay anything for dependent coverage, okay? So, again, for purposes of 2015, if you're a large employer, you would need to offer dependent coverage, not spousal coverage, although you can if you want. But only dependent coverage, and they can charge a separate premium for that, and you don't have to kick in any of that. You can make that entirely, employee paid, okay? You just need to offer it.
Katherine, just to expand on that, we've had a couple of store owners ask us, should they not provide spousal coverage in their benefit plan in order to allow the spouses to go to the exchange? In other words, if they do provide it for spouses, are the spouses excluded from going to the exchange, and would it be beneficial to exclude them?
That is a very good question. And the spouse can go onto the exchange and get individual coverage even if the spouse would be eligible for group coverage through the employer, okay? So in that respect, the employee, if you offer spousal coverage, the employee can make the determination whether it's better to go ahead and add the spouse to their coverage or if it's better for the spouse to go onto the exchange. If the spouse goes onto the exchange, there's no penalty involved because it doesn't matter if the spouse goes on the exchange. The penalty only kicks in if the employee has to go onto the exchange and get coverage and get a subsidy. So it's entirely up to you how you want to offer it because they can always decline spousal coverage. Usually how it's set up is that there's, a premium for employee-only coverage. There's an additional premium for employee plus spouse. There's a different premium for employee plus dependents, and then there's family coverage, which takes care of everybody. The law only requires, for large employers in 2015, that you have that employee only plus the dependents. If you choose to make available to them spousal coverage or family coverage, which is dependents plus spouse, then you may do so, but you're not required to, and there's no downside really if the spouse ends up on if the spouse declines coverage and ends up on the exchange. There's no penalty to you for that.
Does that affect the spouse's eligibility for subsidy?
It may or may not, depending on how it affects the income level for subsidies. Yeah.
Okay. let's see, we've got another question. We could select one. I don't know about Western Grocers Trust. We're not really sure where we're on our list. Okay, we'll follow up with you individually on that. Now, if you were notified about this event, you are eligible for the trust. You may be on our list of eligible employers. So thank you for participating. Diane, maybe at the top, I don't think we've got Diane's question. There we go. To determine if the plan offered is considered affordable, does it have to meet all three of the criteria or just one?
You can use, that's a good question. You can use any one of the three to determine it, but the safe harbor looks at the W-2 criteria. So to be safest, you know, I would look at the W-2 criteria because that's the one that they look at for purposes of the safe harbor provision. But you can use any one of those three. But if you use like the federal poverty level, and again, you know, it could be affordable. 9.5%, you know, could be a lot less if they have a spouse who's, you know, for example, a lawyer or something and making plenty of money. Then clearly what they're paying for a premium for employee-only coverage is less than 9.5% of their household income. But to be on the safe side, you just use one of those methods of determining what it is based on the information you know. For purposes of the safe harbor, it's best to use the W-2 because that's what's in the safe harbor.
Oh. Let's check on another one. I'm going to skip to one of the earlier questions while we're doing that. One employer asked that their requirements for benefits are more hours than the ACA. I assume what they're asking is, if they're a small employer, is it okay to require, say, 40 hours to qualify at 40 hours for full time?
Yes, that's fine. If you are a small employer, you can require 40 hours for coverage, you know, or make sure that, you know, full-time employees who work 40 hours a week, only those are entitled to be covered under the plan. That's fine. You can require that forever until the law changes. It's just for large employers starting in 2015, that drops down to 30. We've gotten some more questions that have popped up.
Okay, if an employee goes on a non-FMLA leave of absence during his or her stability period, are we required to continue benefits under the ACA?
They can pay for it themselves. I'm not quite sure what you mean by the non-stability period, but if they're not on similar leave, then, and they're going to be gone for a long period of time, then they have the option to COBRA. Okay? I mean, COBRA has not been eliminated by the ACA. Okay? And I assume when you're talking about leave, you know they're coming back, and so they can just COBRA during that period of time. You're not required to pay for it.
Same COBRA rules apply then. Ross, one employer asked, is there anything they need to do to prepare for the future of the ACA that they're not doing already? You have any comment on that?
Well, the only comment would be, I think Katherine has done an excellent job at covering what you are required to do. Obviously, a little bit of flexibility, but I think the primary thing is continue to focus on the purpose of your business and, you know, servicing the customers and selling groceries. My sense is that a lot for small employers, as Katherine pointed out, the plan has a lot to do and is doing it. You don't need to worry about that. For larger employers, at least until 2015, there's not really anything more for you to do either as far as the pay or play penalty is concerned, or the ACA. Undoubtedly, this law will change in some form or another, so as business people, we just have to be flexible and responsive to those changes, and then from our standpoint, from the trust standpoint, we'll do everything we can to keep you current.
And I think to add to that, the only thing is to make sure you change your benefit explanations in your employee booklets to comply with any of the requirements that you as a small or large employer are responsible for. Chris asked the question, Katherine, when we start counting the 90 days, from January 1, or do you look back 90 days from January 1. Also, is there a year to decide if an employee is part-time or full-time if you are in question when they are hired?
All right. For the 90 days, I assume you're talking about the eligibility requirements. That's 90 days from hire. Ross, correct me if I'm wrong, but your plan years generally start January 1.
Yes.
Okay?
Yes.
So starting in January 1, your new hires cannot wait longer for 90 days for coverage. Okay? If you have someone who's been working for 30 days, you should, when January 1 starts, I would just go ahead and apply the 90 days. I don't think it'd be probably prudent to make them wait 6 months if that's what your plan says, because as of January 1, according to the law, that's, a 90-day wait is a maximum from when they become eligible. So I would just look at your employee's date of hire, and if you right now have a waiting provision that's longer than 90 days, starting January 1, make sure that they don't have to wait longer than 90 days to get their coverage, okay? So shorten it for anybody if you need to from their date of hire if they were hired before January 1. And then the other question was, is there a year to decide if an employee is part-time or full-time if you're in question when they are hired? Basically what you do, the easiest thing to do, well, I don't know if it's easy, but you just look at all the hours that everybody has logged, okay, and figure out for purposes of, we're talking about two different things here. One is for determining whether you're a large employer, and then you just look back over the year and you look at the hours that people have logged and you figure out your full-time equivalents, okay? And in that respect, it doesn't matter if they're full-time and part-time because you're just looking at hours. I think maybe the second part of the question might be, how do you determine if they're part-time or full-time? Are they working, over 40 hours, under 40 hours? Does it fluctuate? Starting in 2015, are they over 30 hours? Are they under 30 hours? I think what you need to do is define in your employee handbook what full-time means, okay? And then you either have a full-time employee or you have a part-time employee. And that way, if they're fluctuating, then you need to just define them separate. They'd be full-time or they'd be part-time with overtime is basically what it is.
So do we know if there's a period of time that you have, say, some employees work part-time, but then during 1 week they were full-time, and then they went back to part-time. Is there any guidelines that we know of at this point on? Do you have to look at it over a period of a month or 2 months, or do we know?
Not that I am aware of off the top of my head. Let me tell you that the rules governing these calculations, what I have given you may seem very complicated, but believe me, if you look at what, Health and Human Services and the IRS have promulgated, it's even more confusing. There are lots of different ways to sort of figure out how to calculate how many employees you have over a period of time, and I've done the most simple one. If you like, I can send you guidance from the IRS on how to calculate that. I am not aware right now of anything that tells you how you classify someone as full-time or part-time depending on how their hours fluctuate. That doesn't mean there's not something out there from the IRS that's in there that I'm just not aware of or that give you various options for doing things, and I'd be happy to follow up on that if you like.
Megan wants to know if there are any rules surrounding someone who's rehired. Are they treated the same as a new hire? In other words, they have to start a new waiting period.
Yes. There are no special rules for rehires.
Okay. Mike would like to know if he can get a copy of the PowerPoint emailed to them.
Yes. I think there's a way to, Nicole was saying there's a way to download it, and I think that's in PDF format if you want to access.
I can jump on real quick. If you did want to get a copy right now, you can download it by clicking on the printer icon at the bottom right corner of your live meeting console. Also on the page where you registered, there is a PDF copy available there as well. And
Gail wants to revisit this confusing question about two stores with separate federal tax ID but the same ownership, are they separate for purposes of calculating the number of full-time equivalents? I think the answer is no, they are not. Could you reaffirm that?
Again, I think that no, they are not, but I'd have to revisit the common ownership question. There's a very long, what happens with the ACA is there's like this short answer that says this is what the answer is, and then when you drill down, there's like 3 pages of guidance and regulations as to various options. Just like when I said the basic pay or play penalty is large employers must provide minimum essential coverage to full-time employees and their dependents. Every single one of those terms is defined and can go on for several pages. The same thing happens with this common ownership sort of situation. And the short answer is that if you are aggregated for purposes of IRS, then you aggregate them for purposes of the ACA, okay? What I can do is provide you with more guidance on an individual basis after I've had a chance to look at it, because I know it's out there. I just don't know it off the top of my head because these get very confusing very quickly with IRS guidance. And just for an example, let me just tell you that the IRS has changed its guidance on certain things like 3 times just in the last 6 months. And so I have to constantly check and make sure what the guidance is. So I don't know if people have my email address or contact information. What you can do is just contact the trust with your specific question, and Ross will get in touch with me, and I will email that stuff to you. I will get back to you with the answer to your question, I promise.
And we do have a National Grocers Association article on that topic of common ownership that we'd be glad to share as well. And I think that concludes all the questions that we have addressed. Maybe the one that was written in earlier that we might not have touched on is what effect does our plan have on employee dependence in the open marketplace? I think we've pretty well touched on that, but the employee dependents they are open to pursue their own coverage in the marketplace even though the plan is there. Is that correct?
Yes. Well, and dependents fluctuate. If they're up to age 26, obviously, the employee as a parent doesn't necessarily have to cover their child age 20. They don't have to, have their 25-year-old child as a dependent and don't have to pay for it. If the employee chooses to have and pay for dependent coverage, then they're covered up to age 26, and the employer who's over 50 employees in 2015 must make that available to them. If they're children, if they're 5 years old, then somebody's got to provide coverage to them. And it's either the employee who gets it through dependent coverage that's offered by the employer, if you're over 50 or more in 2015, or, dependent coverage is available, through the exchange.
One other written-in question was, is there an amount that the employee has to claim on their tax return as income?
Not for health coverage. What the employer is, if you're under 250 employees, then no, nothing has to be claimed as income. There is a box there now, that employers already fill out for what they provide. But the ACA doesn't have any additional requirements beyond what's already required for employers that are fewer than 250 employees. If you have more than 250 employees, then the employer has to start reporting how much is provided, the amount of benefit that's provided, and that's just right now for reporting purposes only. It's not taxable. It's just so the IRS can start tracking who's getting coverage through their employer, who's not getting coverage through their employer. It's informational only.
Very good. And the last question that I just want to confirm we answered was about temporary hires. And I assume that we're still talking about the 90-day limitation on a temporary hire. or they're not.
If they're going to be longer than 90 days, then they're kind of a hire, and you're going to be on the hook. Again, I'm going to have to do the caveat. This is for large, if you're concerned about having to provide insurance to temporary employees, right now you don't have to provide, nobody has to provide insurance to temporary employees. Employers that have fewer than 50 FTEs don't have to provide coverage to temporary employees ever. When we're talking about having to provide, are temporary employees required to be provided or offered coverage? Now we're talking only about 2015 for large employers, okay? At which point, if they're going to be working for longer than 90 days, then they're going to be employees, and they should be offered coverage. But again, that's only 2015 for large employers. Right now, temporary employees don't have to be covered by anyone. You did get another question in?
One more question from Diane. When we complete open enrollment, if an employee does not take the insurance we offer, can they enroll at a later date if they choose? Example, 6 months later, things might change for them.
Yes, they can change things later. There's various, there's open enrollment, and then there's other events, qualifying events that happen. If they get divorced, if they get married, if they have a baby, if their spouse loses coverage and they were covered under their spouse's plan, those are all qualifying events where they can go ahead and opt to get covered under the plan.
And let's emphasize that it has to be one of those qualifying events. They cannot just enroll because all of a sudden they decided they needed medical insurance. And with that, I think we've answered all the questions. Thank you, Katherine and Ross.
Again, I'd like to say that this is very complicated, and I have a giant book here with questions, and I know that I've read a lot of this stuff, and I know the answers, and I know it's available. I just don't have it off the top of my head. So if you have further questions or want me to follow up on questions that I was unable to answer for you during this webinar, please just contact Tom or Ross, and I promise I will get back to you with the answer after I've had a chance to look at it, because I don't want to give you the wrong answer off the top of my head. Ross?
That's the end of the session, and thanks everyone for staying with us and for participating. We hope we answered your questions. Katherine's done an excellent job, and Tom, in asking and quoting on the questions. So thank you all very much, and I'll say goodbye.
Thank you.
Thank you, Ross, Tom, and Katherine. As a reminder, you may download a copy of today's presentation by clicking on the printer icon that's located in the lower right corner of the live meeting console. Ladies and gentlemen, that concludes today's live meeting. Your live meeting console will remain active while you are logged in case you did want to go ahead and download a copy of today's presentation. But this concludes the audio portion of the event. Thank you so much for joining us today. You may now disconnect.